Good morning, everybody. Damien here. The stock market just opened and it's time to start trading some options. And what I'm going to do today is show you a very simple options trading strategy that you can do with little capital. So this trade, I'm going to show you this exact trade I'm going to do live on the video. Takes less than $1,000 in capital, so about $850. And I'm using it to generate about $25 to $30 a week in income. So what I'm going to be doing is a very simple options trading strategy that works great for beginners, and it's called the wheel. And what the wheel is it's a combination of two very popular options trading strategies. You start by selling a cash secured put on a stock, and if the stock price goes below the price that you sold that put at, you take assignment on the shares. So you purchase 100 shares of the stock for each contract that you sold. And once you get assigned, you sell a covered call against those shares to continue collecting premium. So you just follow this basically wheel. So you sell a put. If you get assigned, you sell a covered call. If you get assigned, you sell another put. If you get assigned again, you sell another covered call. And if you don't get assigned, you just kind of keep selling puts or keep selling calls until you do get assigned. You can really exit this trade whenever. Whenever your covered call gets assigned, or if your put side doesn't get assigned, you can just exit and stop trading. But it's a great way to generate income from selling premium in options. I'm going to jump in and share my screen on Tastyworks. That's the broker that I use. There's a link below in the description if you want to get signed up with them. They're great if you're into strategies that sell options. Okay, so here you can see my screen on Tastyworks. The stock that we're looking at today is Lucid, the ticker symbol LCID. So I actually already started this strategy. So last week I sold a $9 put on Lucid. I did this the day before earnings came out. So I sold this put here on the 22nd, if you're looking at my screen. So when Lucid price was right around $10, and I knew that it was the day before earnings were coming out, and I was expecting maybe the shares would go up, and if they would, I would just my put would expire worthless, and I would just collect the $38 for this trade. But if Lucid did drop, then I had quite a bit of premium that brought my break even down to about $8.62, which is the strike price minus the premium that you collected. Okay, so Lucid here, I sold this put on the 22nd. Earnings came out, the stock tanked, about 12-15%, and it dropped down to about $8.60. So that was below my strike price of $9. So after earnings, the stock price fell below my strike price. So what I was doing then, I wasn't too worried about it because I was just going to take assignment. So if the stock price is below the strike price that you chose when you sold those options, what you do during the wheel is you take assignment. So just to recap this trade so far, I sold a cash secured put. I collected 38 cents in premium. And then I purchased 100 shares of Lucid for $9 a share. So that cost me $900, but I had the 38 cents per share. So really, my cost basis for these is about $8.62 minus some fees or plus some fees. So Lucid is still below that $9. So what I'm going to do today is I plan to come in and sell a covered call because I now own 100 shares of Lucid, and I'm going to sell a covered call at the $9 strike price. And I'm going to do this every week. So as long as Lucid is below $9, I'm going to keep selling that $9 covered call every week. And if Lucid ever goes above $9, what I'll do is I'll take assignment. I'll keep the premium that I collected on the covered call side, and I'll probably end this trade. And that trade will be profitable because, I bought the shares of Lucid for $9, and then I would end up selling them for $9 a piece if I sold a covered call at $9. And I'll just collect whatever premium that I've collected on both sides of that trade. And I wanted to do this with 100 shares to show everyone, that you can get started doing an options trading strategy, with less than $1,000. Now, to show you how we're actually going to sell this covered call, if you're using Tastyworks, I'm going to go to this trade screen right here. And this is Lucid, so the Lucid symbol. And we're going to go to the 4-day expiration. So the ones that expire March 3rd, which is this Friday, it's currently February 27th. And what I'm going to do is here we have the $9 calls. So the calls here are on the left. This middle column is the strike price of your options. So last week, what I did is I came on this side and I came slightly out of the money. So since I was getting the trade started, and I sold this put right here. And earlier, the price was elevated because earnings were coming out. So these were like 38 cents. So I was like, wow, that's a lot of premium that you could get relative to like the price of the stock. So the premiums have gone down a bit after earnings came out, but they're still pretty high. As you can see, see the volatility, the IV is currently, or the implied volatility is currently around 116% for these weekly options, which is pretty high. If it's high like that, you can collect a decent amount of premium. Okay, so I'm going to come here and I'm going to sell. So I'm going to click on this. If you click on the bid in Tastyworks, it automatically goes to sell. And you can see this is good because the spread is really tight. So 25, 26. It's kind of bouncing around. I'd like to get $26 from it, but I'll be happy with 25. So it was like 22 cents earlier this morning. So it's already kind of gone up a bit. So let me see while this is like bouncing around on the screen. So I'm going to put in a price, sell to open. So I'm going to sell this and collect the premium. You can see this is the third negative 37 delta. So we're selling the $9 strike, which is the same strike that we opened this trade at. You can see I own 100 shares for $9 a piece. And I like to stay at that same strike price if possible. And that's kind of, you just collect the premium on both sides when you're doing the wheel. So I'm going to go ahead and send this for 25 cents because it looks like it'll probably get filled right now. So review. Cost me $1. It costs you to open the trade in Tastyworks, $1 per options contract, but it doesn't cost you to close. All right, so let's send this order. Boom, it was filled. Okay, perfect. Let's just recap what we've done so far on this trade. So to get started, I sold a put for 38 cents. So that's plus $38. Then I bought 100 shares for $9 a piece. So that's minus $900, right? But I still own the shares. And then today I just collected $25, so plus $25, 25 cents a share on 100 shares for selling the call. So if Lucid ends above $9, so above this strike price, my shares will get called away because I'm not going to close this. I'm not going to buy this call option back. And if those shares get called away, so I'll break even on the shares, right? I bought them for $9 and I would have sold them for $9, but I would have collected 25 cents on the call side and 38 cents on the put side. So my total profit for this trade would be $63 minus the fees in Tastyworks, which are probably about $3 total for the entire trade. You want to find out your ROI. So $63, this trade took about $900 in capital to execute. So we do $63 divided by $900 and you get 7%. So this trade, if Lucid ends up above $9 at the end of this week, it'll have a 7% return over 2 weeks. Now that's great. If Lucid is below $9 on March 3rd in 4 days, then this option, this will go to zero, right? But I sold to open, so I just won't buy it back. I'll keep the $25. And what I'll do next week is I'll come in and I'll sell another call for $9. Hopefully collecting about $25 each week. So you could see this trade is about $25 a week, so about $100 a month off $900 in initial capital. This is also a very scalable strategy. So say if you just wanted to multiply this times 10, if you had $9,000 and you wanted to play this trade, you could easily collect about $250 a week, assuming that Lucid, the stock doesn't completely tank. So let's go back to the chart and you could see it has recently, around Christmas of this year, been down to about $6. So the problem is if the stock did tank down to about $6, we come back here, you could see that if you go too far out of the money, so about $12, $11, you wouldn't be collecting that much in premium. So if the stock tanks, like the value of our shares that we own will also tank. And we still don't want to sell calls below our initial call spaces of $9. So we would be collecting less premiums. The big risk with this strategy is if the share price tanks, the amount that we collect each week from these options will also go down. So it could go from $25 a week to, $5 a week, I'd say is like probably worst case scenario. Now, what you could do then is you could lower the strike price that you sell your calls at, but then you open yourself up to facing a loss on the shares. I'm a bit torn on Lucid. I was bullish at first, but looking at the amount of vehicles produced in a year, so full year 2022 when the earnings came out, it was pretty low, just over 7,000 cars in 2022. That's not very much, and I think they plan to produce 10,000 to 14,000 cars. For an electric car company, that's just not that much volume. They need a lot more volume, and their production capacity at their plant is actually like 25 to 30,000 cars a day. And personally, what I think the problem with Lucid is that the cars are just too expensive for the average person. If you go here to their available now, what they have available that you could buy, you could see there's nothing under about $138,000. So this is not a cheap car. I mean, this isn't a $50,000 Tesla that even, normal Americans can afford, like, upper middle class Americans would be willing to buy. I mean, this is 170, $180,000 cars that, I mean, you would have to make. I probably wouldn't buy this unless I made at least $1 million a year. And it would probably be even more than that. But the great thing about Lucid, the Saudi fund, Saudi Arabia's public invested fund, owns about 62% of Lucid. So what that tells me is that Lucid isn't going to go bankrupt, and that if Lucid does need more money, that Saudi Arabia, would be willing to invest more to keep this company going and to do what it takes to get them to profitability. So I do think that there's a limit to how far down Lucid could go, that the Saudi Arabia public investment fund would come in and do what's needed to raise the share price. But I do worry about the upside of this stock. So if these shares get called away, I may sell another put, or I may reevaluate, what the premiums look like at that time. Thanks for watching, everyone. If you enjoy this content and you want to learn more about using options to create income for your portfolio, subscribe to my channel. I'll be talking about different strategies, some that are more advanced and some that work great for beginners, just like this one. Have a good day. Let's go out there and make some money.